Welcome to the Cycle Framework Insights podcast with Chief Strategist Bryan Jordan. Hello, this is Miriam Rush from the CFI Podcast, and I am joined once again by our very own Bryan Jordan for a discussion on geopolitics. This is a topic that has been very much in the news recently and one that has often been a source of anxiety for investors. Bryan, this word means different things to different people. So let's start by clarifying what we mean when we use the term geopolitics.
It's true. It can be a confusing term, but technically the word means the influence of the economy and geography on politics and on international relations. Now, in practice, that definition has been very much turned on its head and has come to mean, at least in the financial markets, the influence of politics and international relations on the economy and on the financial markets.
Okay, so given that definition, how often do these geopolitical events occur?
So they occur quite frequently. There are three main types of geopolitical events that the market is concerned with: military conflicts, terrorist attacks, and trade wars. And using that definition, or those three types of geopolitical events, we can see that they happen frequently. We can just look back at recent history and see a steady stream of trade conflicts, wars, and terrorist attacks going back to the 1960s and the Six-Day War, the 1970s, the Yom Kippur War and the Arab oil embargo, the late 1970s, the Iranian Revolution, and the second energy crisis, moving into the early 1990s and the Iraqi invasion of Kuwait, and the first Gulf War. About a decade later, of course, we had 9/11 and then the war on terror. More recently, we've had the US-China trade war. And especially recently, we've had the war in Ukraine and the ongoing war in the Middle East. So these events happen quite frequently.
And how about common threads? Are there any that run through these episodes?
So these are idiosyncratic events. Longtime listeners of our work know that we look at the economy as being not different this time, cycle after cycle, decade after decade. The same fundamental drivers drive economic growth, drive the financial markets. It's not different this time economy. But in terms of these geopolitical events, it's different this time episodes. World War I was different than World War II. The first Gulf War was different than the second Gulf War. The Six-Day War was different than the Yom Kippur War. These are not endogenous drivers, endogenous factors. These are exogenous shocks. And as such, they are different. And because of that, they entail higher risk. There's always a risk that these conflicts can broaden. There's always a risk these conflicts can deepen. And for that reason, the financial markets pay a lot of attention to them.
That brings me to my next question. And I think what our listeners really want to know is the impact that these events have on the economy. How much can these shocks influence economic growth or economic decline, for that matter?
We can divide U.S. history, at least, into three distinct periods in terms of the influence of geopolitical events on the economy, on the business cycle. So for many years, for most of U.S. history, military conflicts, at least, had near-term positive impacts on economic growth. Military conflicts entailed military spending, entailed the hiring of government employees, soldiers. And so we saw healthy economic growth. We saw healthy industrial production growth during these periods. We saw healthy job growth during these periods. We can go all the way back to the Civil War and see the positive impacts, at least the positive near-term impacts on economic growth. We had an expansion during the Civil War in the 1860s that lasted for nearly 4 years, by far the longest expansion in U.S. history to that point, and in fact, a record that wouldn't be broken until World War II, 80 years later, eight decades later. We also had a very long expansion in the 1960s. This was the guns and butter economy of the Vietnam era. So the Civil War gave us a long expansion. World War I gave us a long expansion. World War II gave us a long expansion. That was the record that broke the Civil War record. And then that record was broken in the 1960s with an expansion that was very much driven by the Vietnam War. Now, we had overhangs in all of these cases. Immediately after the Civil War, we had a recession. Immediately after World War I, we had a recession. Immediately after World War II, we had a recession. And just after the Vietnam War as well, we had a recession. There were overhangs, but in the moment, in real time, military conflicts at least had a positive impact on economic growth. So that's period one. Then we had period two, which was a relatively brief period, but a period that produced a couple of major events in U.S. history, especially U.S. economic history, and that was the 1970s. Two major geopolitical events had big negative impacts on the U.S. economy. First, we had the Yom Kippur War in the early 1970s, and from the Yom Kippur War, we had the Arab oil embargo. A very, very deep recession followed shortly thereafter, a 16-month recession from late 1973 to early 1975, a very deep downturn. That downturn can at least be traced in part to the embargo and the effects of the embargo on energy prices and inflation more broadly. Very similarly, later in that same decade, the Iranian Revolution gave rise to the second energy crisis of the 1970s. And very shortly thereafter, the U.S. economy fell into another recession that eventually morphed into a long double dip recession that didn't end until late 1982. So this is period number two, three distinct periods in terms of the impact of geopolitical events on the U.S. economy. The first period, we had military conflicts that boosted economic growth. In the second, relatively brief period in the 1970s, we had energy shocks that weighed heavily on economic growth. And in the more recent period, since the 1980s, we've had a number of geopolitical shocks, a number of geopolitical events, military conflicts, terrorist attacks, trade wars that have had limited impacts, short-lived and limited impacts on economic growth. The U.S. economy was in recession when 9/11 hit, but was growing very shortly after 9/11. The U.S. economy was growing through most of the war in Iraq. The U.S. economy was growing through the early stages of the trade war with China. There were impacts here in these cases, but they were modest and they were short-lived. So a couple of regime shifts and three very distinct periods in U.S. history.
You briefly touched upon a topic that I think is weighing on really everybody's mind, and I'm hoping that you can expand on that, and that is inflation. So what do these events, or what is the impact that these events have on inflation itself?
So again, very distinct periods in U.S. history, very much mirroring the influence that these geopolitical events had on economic growth. So very early on in U.S. history, for many, many years, from the early days of U.S. history until the 1970s, we saw that, again, military conflicts had major impacts on inflation. So we had big inflation during the Civil War in the 1860s. We had big inflation during World War I in the 1910s. We had very big inflation for part of World War II in the 1940s. We had overhangs here as well. After the Civil War ended, we had a long period of deflation. In fact, after the Civil War ended, we didn't have a positive yearly increase, at least according to the data we have for that period. We didn't have a positive yearly increase in consumer prices until the late 1870s. Civil War, of course, ended in 1865. Consumer prices year to year from then on until the late 1870s were either flat or negative every single year. Again, very similar story after World War I. Big inflation during the war, deflation after. We had big inflation during World War II, deflation after World War II. So there were big impacts on the inflation rate on both sides in that first period in U.S. history. Then, of course, we have that middle period in the 1970s when we had a couple of geopolitical events directly tied to energy prices. And those, of course, had major impacts on the inflation rate. There's academic research to suggest that the inflation spike of the early 1970s, for example, was due 1/3 to 1/2 to the Arab oil embargo directly. The Arab oil embargo was directly responsible for 1/3 to 1/2 of the spike in inflation during the early to mid 1970s. We had another spike in inflation after the second energy crisis in the late 1970s. The CPI inflation rate went all the way to 14.8% by early 1980. So huge impacts on inflation in that middle period in the 1970s, that brief middle period in the 1970s. Since then, though, the impacts have been much more limited through the Gulf War, through 9/11, even through the trade war between the U.S. and China. The Federal Reserve Bank of New York, for example, estimates that the trade war, the U.S.-China trade war, has added 0.1 to 0.3 percentage points to the CPI inflation rate on an annual basis per year since the trade war began. That's not nothing, but it's not a game changer in terms of the inflation rate. So again, distinct periods in U.S. history, big impacts on both sides for many years, huge positive impacts in the 1970s, and very, very muted impacts more recently.
Great. If it's okay, I'd like to hone in on the oil discussion. Can you discuss how these events have driven oil prices and how those movements have in turn affected the economy?
Sure. So the oil shocks of the 1970s are really the exemplar here, the exemplars here, and these are the touchstones that we look back to whenever we see oil prices start to climb. Especially these days, we have the risk of a growing conflict in the Middle East. Oil prices have been on the rise, and of course, there are those fears that perhaps we're going back to a 1970s-like environment. And it was a very dire environment from an oil price, energy price, and broader inflation perspective in the 1970s. Oil prices quadrupled during the Arab oil embargo in the early to mid 1970s. This wasn't a long period from August of 1973 to March of 1974, a relatively brief period. And in that time, oil prices quadrupled. They went from $3 a barrel to $12 a barrel. Now, $12 a barrel is not much, and even after you adjust for inflation, it's not exorbitant. $12 per barrel in 1974 is equivalent to $75 to $80 per barrel today, very close to where oil prices are already today. But the U.S. was not energy independent in the 1970s. It's estimated that the Arab oil embargo removed 10% of daily U.S. oil consumption. And there were major impacts of that shock. Oil prices, of course, shot up, but we had a major gasoline shortage. Some of our listeners will remember the long lines at gas stations and the many gas stations that ran out of gasoline during that period. There were many states, for example, that restricted, that rationed gasoline. If you had an even-numbered license plate, you got gas on even-numbered days. If you had an odd-numbered license plate, you got gas on odd-numbered days. So there were gas rations. We had year-round daylight savings time because of the Arab oil embargo, directly tied to the spike in energy prices and the influence that it had on the broader economy. We had a 55-mile-per-hour speed limit instituted because of the Arab oil embargo. And we even had a directive from the White House not to put up Christmas lights in 1973 because of the Arab oil embargo and because of the surge in energy prices. So it wasn't quite the year without a Santa Claus, but it was a year without Christmas lights. So huge impacts on energy prices, on broader inflation, and the broader economy, of course. Very similar story in the late 1970s, the oil shock after the Iranian Revolution. I mentioned earlier, we had a nearly 15% CPI inflation rate. Again, these are the touchstones, and every time oil prices start to creep up, every time the tensions in the Middle East start to rise, we look back to the 1970s as an example of what could happen if events like this spread or deepen. But a very important point to make, perhaps the most important point to make with regard to this subject. The US economy today is not the same as it was in the 1970s, especially with regard to energy. The US became energy independent in 2018. We have produced more than we have consumed in every year since 2019. That obviously wasn't the case, not even close to being the case in the 1970s. And we use energy much more efficiently today than we did in the 1970s. At the time of the Arab oil embargo in the 70s, US energy consumption equaled 12,000 BTUs per unit of GDP. We consume 12,000 BTUs, British thermal units, of energy for every unit, every dollar of GDP. Currently, that number is a little bit over 4,000. We went from 12,000 in the 1970s to just over 4,000 today. We use energy much more efficiently today than we did 50 years ago. And so the risk of a situation like this 1970s is much, much smaller today. The bar is set much higher for an energy shock to drive broader inflation and to drive a US economic downturn. Very much along those lines, the influence of energy prices on non-energy prices is much smaller today than it was in the past. If we just simply look at the correlation, for example, between the energy index within the CPI, within the consumer price index, and non-energy prices in the CPI. So the relationship between energy prices and everything else, not energy prices and non-energy prices. That was a very strong correlation. The correlation was over 70% year-to-year changes in the 1970s. Again, in the 1980s, nearly 80%. The correlation was nearly 80% in the 1980s. In the 1990s, it was closer to 40%. In the 2000s, it was closer to 20%. And in the 2010s, the most recent decade that we have full data for, obviously, that relationship was actually negative. There was a negative relationship between energy prices and non-energy prices. So on balance, in the last decade, when energy prices went up, non-energy prices went down. So in the 1970s, it was the case that when oil prices went up, the price of a loaf of bread went up. The price of a carton of eggs went up. The price of an admission to a movie theater went up. That isn't the case anymore. Energy prices don't have that broad influence that they did in the past. And so they shouldn't be a driver of economic growth or broader inflation as they were in the past.
Great answer, Bryan. But honestly, I'm still stuck on the no Christmas lights at Christmas time. Sounds absolutely horrifying to me. But it is a relief to know that we likely won't have to experience that again. But let's do this. Let's project this discussion to what is going on in the world today. Crude prices have been rising this year as fears have grown of a broader conflict rising in the Middle East. So could this be a trigger that pushes the economy into a downturn?
Well, longtime followers of our work won't be surprised to hear me say that the risk is really driven by what the Fed does and how the Fed reacts to these situations. So there's always the chance that a broader, longer, deeper conflict in the Middle East pushes up energy prices further, drives broader inflation. Now, again, the influence is not nearly what it used to be, but if energy prices by themselves go up, at least headline inflation would move higher on that move. If the Fed reacts to that with tighter monetary policy, the Fed has been on hold since July of last year, but there are some fears now that the Fed might step back in and tighten policy again, resume its tightening cycle. If the Fed were to do that, that's the risk. If the Fed were to respond to higher energy prices and higher overall inflation, a higher headline inflation rate due to higher energy prices, even if non-energy prices don't rise much, that would be the risk. The Fed has already done quite a bit in tightening monetary policy in this cycle, or in the cycle that looks to have ended in July of last year. If it were to do more, if it were to resume the tightening cycle, the rate hike cycle, the risk of a downturn would rise as well.
Okay, so let's move on to something that I think people really want to know is the markets. How have the markets historically reacted to geopolitical events? You've outlined the real economic effects, but have asset prices reacted similarly?
Especially in recent years, they have reacted similarly, or at the very least, we've seen short-lived, relatively modest movements in asset prices in response to geopolitical events. Now, in some cases, we've seen big, short-lived movements. After 9/11, for example, many listeners will remember that the US stock market was shut down for several days after the 9/11 attacks. September 11th was a Tuesday. The US stock market was closed for the rest of that week and didn't open until the following Monday, September 17th. And when it did open, it fell sharply. That first week after 9/11, the S&P 500 was down by 11.6% in 1 week. Huge decline in 1 week. But within 1 month, it was back to its pre-9/11 level. By October 12th of that year, the S&P 500 was back to its pre-9/11 level. Now, it didn't hold that level for very long. We were still in a recession. We were still in a bear market. We were still dealing with the aftermath of the tech bust in 2000. That bear market wouldn't end until late 2002. But in the moment, in real time, the market gained back its losses very, very quickly. After World War II, or after the onset of World War II, at least onset of US involvement in World War II, the markets also fell sharply in the US. It took a little bit longer for them to claw back those losses. There were big declines after the Pearl Harbor attack on December 7th, 1941. The market wasn't shut down then. December 7th was a Sunday. We saw a deep decline on that subsequent Monday, December 8th. But the market, the S&P 500, got back to its pre-December 7th level by October of the following year. And throughout U.S. involvement in World War II, the market did quite well. It was up by 14.6% annualized during U.S. involvement in the war from December of 41 to September of 1942. More recently, again, we've seen relatively muted impacts during these cases, some ripples during the early days of the trade war between the U.S. and China in 2018, some ripples during the period of the war on terror, the U.S. war in Iraq. We've certainly had some ripples more recently with the war in Ukraine and the war in the Middle East. But these haven't been lasting impacts, and they've mostly taken place against backdrops of bull markets. So yes, we've had some short-lived impacts. We haven't had long-lived, especially recently, long-lived deep impacts.
Incredible insights as usual, Bryan. We really appreciate it. Thank you very much. And thank you to everyone who's listening. For more information on this, and of course, many other topics that we cover, make sure to check us out. And we would love to have you join the CFI family at cycleframework.com. And we will catch you on the next episode.